Hello guys, today we are going to do balance of payments. As you can see in the pictures, India is high on debt and loan, and also our imports have become very high, whereas our exports have become very slim, as you can see here. So these are the two takeaways that you can get from our balance of payments. Let's start. What is BOP? First of all, if we look at the definition, BOP records transactions in goods, services, and assets between residents of a country with the rest of the world. So, what balance of payment records is basically whatever transactions of goods, services, and assets happens between a country with the rest of the world. Whatever India exports in terms of goods and services, whatever it uh, generates by transferring capital assets, whatever incomes it gets through various services, and whatever it has to pay when it takes various services and goods from the rest of the world, the balance between these two becomes balance of payment. Balance of payment has three major components, which are current account, capital account, and official reserve account. Now these three components have subcomponents. Let's look at them. Current account has a major component which is called trade in goods and services. This is export as well as import of goods and services. Second is unilateral transfers, remittances, foreign aid, grants. We will talk about this in detail in further slides. What are unilateral transfers? These are transfers which do not create a liability or a counter liability for a domestic country. For example, if India receives remittances from NRIs from around the world, it does not have to pay those people back in any terms. So those are unilateral transfers. Similarly, when India receives foreign aid or grants from any country, it does not need to pay them back. So those are unilateral transfers. Third is factor income. What is factor income? Interest and dividends. Factor income is linked to FDI and purchase and sale of capital assets. Let me come to this first. Second is capital account. Capital account has also three components: purchase and sale of capital assets. Capital assets means assets like machinery, like other capital assets. Foreign direct investment, domestic and overseas, as well as foreign portfolio investment. Now, how are these linked to factor income? When if we take the example of India, when overseas investors or foreign investors invest in India through direct investment, they buy a majority stake in a company, or they invest in greenfield or new investments. Then whatever income that entity generates over time, those foreign investors take a part of that income through either interest or dividend. So they invested in India in the starting, they gave money to India, and now they're taking back money from India through dividends and interest. So that is called factor income. Factor income can be outgoing as well as incoming. In case of overseas investments, what are overseas direct investment? These are investments made by Indian entities or Indian people overseas. So these are reverse of FDIs in India. So when there are overseas direct investment, for example, if Tata invests somewhere outside in Jaguar or something, then the dividends and the interest that he earns over time becomes factor income, which is positive for India. The difference between FDI and FPI I will cover in the further slides. Third is official reserve account. These are the reserves which central bank of a country and otherwise are held in the country. So these contain of gold, first of all. Secondly, foreign exchange reserves, which are almost 350 billion for India right now. Third is special drawing rights, and fourth is reserve position in IMF. These are the four official reserves. Let's look at current account. So current account, the first component in current account was trade in goods and services. Trade means exports as well as imports. So receipt of goods or services and payment in money and vice versa. So when you receive goods and services and pay in money, which is imports, and vice versa, that is exports. Includes merchandise trade and invisible trade. Both the trades are included in this. The balance of exports and imports of goods is referred to a trade balance. So there are three major terms in BOP: current account balance, capital account balance, and trade balance. Trade balance is the balance between exports and imports of goods only. So it does not include services. It does not include services, only goods, and it does not include capital account, only current account. This is called trade balance. Second component is unilateral transfers. What are these? These are one directional flows without offsetting flows. So these are unidirectional flows which happen inside the economy, towards the economy, or outside from the economy. Remittances, grants have no counter flow. You are not required to pay back anything in terms of remittances that you receive or grants that you receive. Those are unilateral transfers. Third component is factor income. Factor income I've already explained. Payments and receipts. Either you pay or you receive interest or dividends and other income on foreign investments made previously. So whatever foreign investment made either by the government or by the private sector previously, and whatever interest and dividends are received or paid, that become part of factor income. Fourth is the last is current account balance summation. So summation of all three above mentioned factors gives current account balance. Remember, trade account balance, current capital account balance. They can be current account balance. They can be current account surplus as well as deficit. Any deficit in current account balance, how is it financed? It's financed by either net capital inflows, that is a surplus in capital account balance, or by using reserves of foreign exchange. So you can finance current account deficit by either having a surplus in capital account or by using your reserves in the foreign exchange. J curve effect, very important, both for economics optional as and otherwise can be asked as well. Very simple and very basic in nature. What is J curve effect? When any country's currency depreciates, when there is a depreciation of the currency, you all know that exports become competitive and imports become costlier, because when your currency depreciates, if for example it was 50 and now it is 60, so when you import you're required to pay more money. You're required to pay in terms of 60 rupees per dollar, or in terms of any other currency, and you were required to pay only 50 rupees before. So imports become competitive, but when you export you get more money out of it. So in case of depreciation, export should increase and import should decrease, but that does not happen immediately. There is a time lag between increase in exports and decrease in imports. That time lag gives rise to the J effect, J curve effect. Let's read this. Following a depreciation, the trade balance may at first deteriorate for a while. Why? Because when the currency is depreciated, whatever you were importing, you will continue to import the same things for a while. It will take some time for the domestic economy to offset those imports with certain domestic production. So if you were importing heavy amounts of capital, it may take you some time to mm, produce those capital assets in the domestic economy only, rather than importing them. So that time lag gives rise to this J effect. Because of that time lag, your expenses on imports increases, so your deficit also increases. But your exports take time to become competitive. So when the exports start becoming competitive, then your deficit starts reducing and you enter a surplus area. For India, it did not happen because the imports that we have had are very sticky in nature. What are sticky imports? Imports that are necessary or that cannot be produced by the domestic economy. For example, oil imports. Whatever imports that we make in terms of oil, we cannot produce that domestically. We have to import it. So, because of lack of substitute or lack of any other alternative, we keep importing these things and we keep paying higher price for those imports. Therefore, it stops our deficit, or JFX stops here only. It does not go up from the deficit to surplus situation. This is the J curve effect. Second is, another thing is capital account. Now capital account had three subcomponents. The first of that is purchase and sale of capital assets. What is this? Indian sale of assets here we are talking about financial assets as well as capital assets. So real assets and financial assets, the sale of assets, that is exports, is recorded as credit as it results in capital inflow. So when you export machinery or any other financial asset or capital asset, then you receive money out of it. So that inflow of money is recorded as capital inflow and credit in current account balance. And vice versa, in purchase of assets is recorded as debit. Trade in financial and capital assets affect future payments and receipts of factor income. As I had told you in the factor income link between factor income and purchase and sale of capital assets, whenever a country invests outside or sells outside in terms of financial or capital assets, then it may attain future benefits from that investment in terms of interest or dividends. So, trade in financial and capital assets affect future payments and receipts of factor income. Now, a question can be asked very easily as to what factor affects future payments and receipts of factor income. Is it the current account or the capital account? Or it can be reframed as, is it trade in exports, trade in consumption goods and services, or trade in financial and capital assets. The second component is FDI and the third component is FPI. What is FDI and FPI? FDI, foreign direct investment, is a long-term investment in a foreign country in order to attain benefits in the longer period. So these are long-term investments. These are majority or big stakes in in various companies in the foreign country in order to attain benefits in longer period. For example, if Tata has invested in Jaguar, then it's an overseas direct investment, an investment from India outside the country. So it's an FDI because it is a long term investment and it has long term advantages and disadvantages for the country as a whole. On the other hand, FPI is short term investment in financial assets of a foreign country. FPI investments are basically in financial assets of the country, of a foreign country, to take advantage of market movements. As you all know, India investments in India in terms of FPI are much more than what we have in terms of FDI. So this is also called hot money because it can run out of the economy whenever it senses that the financial markets are not doing well. So these are very volatile in nature, whereas FDI is very stable in nature. Now, if we look at technical difference between them, more than 10% investment by a foreign entity in India is called FDI. So any investment more than 10% is called FDI, whereas if the investment in an entity is less than or equal to 10%, it is called FPI. The third is official reserve account. Transactions undertaken by authorities. Now, what does official reserve account contain of? There are four subcomponents: gold, reserves in terms of gold, reserves in terms of foreign exchanges, reserves in terms of special drawing rights of IMF, and also reserve position in IMF. These are the four components that they have. What are official reserves? These are transactions undertaken by authorities to finance the overall balance and intervene in foreign exchange markets. So, official reserves, why are they kept by India or by any other country? They are kept in order to help the authorities, the government, or the RBI to finance the overall balance and intervene in foreign exchange markets. There are two basic uh, advantages or two basic objectives of keeping official reserves. First is to intervene in foreign exchange markets. Whenever the RBI senses that the foreign exchange market is not going as planned or is becoming very volatile, then it may interfere through official reserves. And official reserves can also be used to maintain overall balance in the BOP. How can that be done? For example, if there is current account surplus and the current account deficit, and capital account surplus is not enough to offset the current account deficit, then how will the country create a balance in the balance of payment? It will use its official reserves in order to complete the current account deficit that is remaining. So these are the two activities. Authorities use official reserves to either support or change value of domestic currency, that is rupee here. So if the rupee is depreciating very fast or appreciating very fast, and it's not good for domestic economy, then the RBI may intervene and may start to increase or decrease the value of domestic currency through its official reserves, or to balance deficit at current and capital account. I've already explained this. These are the two important implications. When RBI wants to support value of rupee, what happens when RBI wants to support value of rupee? So which means that the rupee is depreciating very fast. It would buy more rupee in the market to increase demand for rupees. So there's a direct relation between value of rupee and demand. So if you want to increase your value, what you have to do is you have to create demand for rupee. How will you do that? You will start buying more rupee. When you start buying more rupee from the market, the demand will increase. As the demand increases, the value also increases. When RBI wants to weaken rupee, it would sell rupee in the market to increase its supply. When the supply of rupee will increase, then there will be a lot of rupee in the market. That will itself depreciate the currency. More supply will reduce value of rupee. This is how RBI intervenes and changes the value of rupee. Very important concept, quality of deficit. Now it's not only simply fiscal deficit or current account deficit that matters. What matters more is the quality of deficit that a country has. Now every year each country need not achieve BOP equilibrium. It's not necessary, especially for a developing country like India. It's not important that we have equilibrium every year. How and why? If a country has BOP deficit due to import demand for capital goods that are necessary for economic development, the deficit can be self-correcting. This is the important word, self-correcting. So when you are importing a lot of capital goods, you are importing a lot of things that are important for economic development in the future, then the deficit will be self-correcting. How? Because those capital goods which are installed in the economy presently by imports will start producing a lot of goods. When they start producing a lot of goods and start exporting, the country may generate current account surplus in the future. The country may have a lot of exports in the future. However, trade deficit is a result of importing consumption goods. What happens when the people are importing a lot of goods in order to consume snacks, toasters, all these things, which are consumption goods. If you're importing a lot of consumption goods, the situation will not correct itself. The productivity will not rise by itself in case of import of consumption goods. Therefore, what matters is nature and causes of disequilibrium. So, if the deficit is because of high import of or high demand for capital goods, it may be beneficial for the economy in the future. But if the imports are due to high consumption goods imports, then the situation can be dangerous in the future. Now two questions. The first one is, what are twin deficits? I have not explained this. I'll explain this in the next slide. Let me take the question first. What are twin deficits? Current account deficit and capital account deficit. Current account deficit and fiscal deficit. You must have read this a lot of times in the newspaper. That is why I asked this very simple question. And how to explain also what are twin deficits. Twin deficits are current account deficit as well as fiscal deficit. They are said to go hand in hand at some points of time for an economy. At that time, they are called twin deficits. Second question is, in case of a weakened or depreciated rupee, how can RBI intervene? I've already explained this. When a rupee depreciates, how does RBI intervene? So when the rupee is depreciated, RBI will start buying more rupees. Why? Because when it buys a lot of rupees, it creates demand for rupee in the market. An increased demand increases the or improves the value of rupee. Thus, the rupee will start appreciating. So the answer is by buying rupees from the market, not by buying selling rupees, and not also by buying dollars from the market. What is twin deficit? In 1980s in the US, twin deficit was led by, so twin deficit can result from a variety of situations. It is not only a single chain reaction. There may be multiple chains or there may be a web-like structure in twin deficit. So the first which happened in 1980s was in the US when there were high tax cuts. Taxes were reduced. What was the result? Less revenue collection for the government. When the taxes are less, the government is able to collect less. When it collects less or has less revenue, then the fiscal deficit is bound to increase, which were not matched by spending cuts. So tax cuts did not result in spending cuts by the people. So when people are not cutting their expenditure or their spending, then the amount of imports in terms of consumption imports or capital imports that the country has will not go down. So a sticky import and combined with less revenue and high fiscal deficit for the government resulted in twin deficit, because this resulted in high fiscal deficit and high imports or sticky imports here resulted in high CAD. The same was repeated in the US in early 2000s. In India, how did it happen in India? High fiscal deficit eroded investor confidence. So there was high fiscal deficit already. It eroded investor confidence and forced investments into gold, resulting in higher gold imports. So investors, both uh, institutional as well as retail investors, lost confidence in the market. When an investor loses confidence, he starts looking for alternative investments. That is when gold came in handy. People started investing in gold. So gold imports increased. When gold imports increased, CAD increased, and there was already high fiscal deficit. Another way that fiscal deficit may give rise to high CAD is fiscal deficit may drive up inflation. So when there is high fiscal deficit, that means there is high supply of rupee in the market, because the government is spending a lot in the market, through various programs, job creation programs, and things like that, in order to boost up the economy. So when fiscal deficit is high, there is bound to be high inflation or an inflationary effect in the economy. When there is high inflation, the monetary policy will react by increasing interest rates. So high inflation, high interest rates, fiscal deficit. When there are high interest rates as well as high inflation, the exports are bound to be less competitive. Why? Because when there is inflation, the cost of products will go up. Exports become less competitive. When there are high interest rates, more investment does not happen in the economy. So the economy starts importing rather than exporting a lot, because investments in the economy are expensive. So new industries will not set up. People will, the economy will start importing rather than creating its own industry. So exports become less competitive. When exports become less competitive, then CAD automatically rises. This is how twin deficit may work. Thank you.